Should be good to go. Okay, thanks everybody. My name's Chris Malloy. I'm the Chief Investment Officer for Morrows. We've got some clients in the room personally and also dialing in via teleconference today, so hopefully we'll be able to satisfy both requirements quite well. We've got Dale Holmes and Chris Nile from Spire Capital, who will also be seeding the fund alongside the EVP guys. Les Szekely in the room, who will be presenting today. I'll hand over to Dale to give a background to Les, but yeah, this is a really informal type of briefing. Let's ask lots of questions and make the most out of the opportunity whilst we've got Les in the room. So I'll hand over to Dale.
Thanks, Chris, and thanks everyone for joining us both here in the room and on the phone. So I'm the Director of Spire Capital. Spire Capital is a business that looks to partner with investment managers around the world and bring those opportunities to the Australian wealth market with a view that we bring ideas and opportunities that are not easily accessible or replicable by Australian families and investors. So we have a partnership with a US private real estate firm. We have a partnership with a global small cap equities firm based out of Boston. And now we have a partnership with Equity Venture Partners, our VC partner here in Australia. Les is going to talk through EVP in some detail. Suffice to say that before we build a partnership, before we take an offer to the market, the first thing we do is invest ourselves. And so to get comfort around making that investment makes you do thorough due diligence. And the investment we make in all of our fund offerings, we make a $500,000 investment in each of the funds. We think that's the right thing to do, to have skin in the game, be aligned with our investors. But it makes us also go very deep on the due diligence to make sure we feel comfortable with the proposition that we're taking to market. And with EVP, what gave us great comfort in an area which is not well understood, venture capital is an area which a lot of people see as very binary. It's sometimes seen as being, very speculative and a win or loss outcome. What we liked about the EVP model was its focus and target is in the B2B subscription-based software as a service area. And that to us gave us great comfort around how risk could be mitigated and the process of how EVP go through the risk analysis before they even make the investment. So that was number one. Number two was that Les and his co-directors were investing $4 million into the fund itself. So they'll own more than 10% of the fund, which we think is exactly what should happen in terms of alignment and skin in the game. And the other things that gave us great comfort was the depth of the experience of the co-founders, both Howard Liebman and Les Szekely, who have been investing in early stage venture for up to 20 years. And it's not an old industry venture here in Australia. It's a lot older and a lot bigger in the US, of course. But in Australia, it's an area which obviously there's a few new players coming in. We want to be with people who've got experience and skill sets and the right target focus and the right alignment. So that's why we end up doing the partnership with Les and the team. And we really appreciate the opportunity to come and present the opportunity to you today. And I agree with Chris. These sessions are always better as a more sort of relaxed conversation than a presentation. So please ask any questions as we go through. I'll hand over to Les to focus on the slides and that he wants to talk to, and please ask questions as we go.
Okay, well, morning everyone, and thank you for coming along to hear the story of what we're doing. I've got a bunch of slides which I'll go through. I've been asked to sort of keep it to about 30 minutes, and then questions at the end, or if there's anything really burning along the way, we can deal with it. And I won't go through every slide in detail. I'll just try to focus on the highlights that I hope will be of interest to you. Our first thing is the tech. Fantastic. Okay, so where are we? Yeah, okay. The disclaimer comes first, and I'll go fairly quickly because I'm told that most of you are either professionals, accounting and investment, or you've had some previous exposure to the VC sector, or at least some knowledge of it. So I'll go quickly to the beginning slides. The basic proposition, the first proposition, is maybe one of the world's most famous VC investors has said, software is eating the world. If you look at where all the growth, and I mean growth, not hype, not fad, the things we can all see ahead, with certainty. We may not know the detail, we may not know which of the individual companies are going to win, but we can see with a high degree of certainty the changes that are ahead in our society, in education, in health, in transport, in every area of our lives that are being driven by changes in business model, changes in the way goods and services are produced and distributed and manufactured, driven in most cases by new abilities, new capabilities in technology. But again, I've got to stress, my interest, our interest as a fund manager is not in technology. We actually do not invest in technology at all. We don't claim technical expertise. We have no PhDs in artificial intelligence. We are about picking businesses which have the potential to generate extraordinary profits, and they have that potential because, and this is where people often misunderstand, they're startups in the technical sense. Now, in the technical sense, a startup is a company that's either doing something new or doing something very old in a new way which disrupts an existing industry. So by way of example, my first learnings on startup came with a gentleman called Leon Kamenev, who started a business called Hotel Club, which was acquired by the group that ultimately became Bookings.com back in 2004. And back when I first started working with Leon in 1999, at that time in Australia, everyone said, oh, people won't ever use an internet online, use a credit card online. Now, that'll never happen. Anyone old enough to remember that? That was when we started in that business, or when I helped Leon. We actually were involved together right from the beginning. Now, Leon was an inbound tourism operator. And for those that don't know the travel industry, back in the 1990s, if you wanted to travel overseas, your travel agent was a member of IATA. You booked your airfares through a travel agent. It was just about the only way. Couldn't do them online. And that travel agent, when you said, what about a hotel room? He sent an email or maybe even a fax or telex to somebody offshore who had supply of local hotel rooms, had contracts with all the local hotels. Leon was in that business of inbound tourism, sorting out the hotels. His customers were foreign travel agents. He started posting that stuff up passively on the internet because he said, why do we need all these telexes and faxes? I've got the inventory. Why can't I sell direct? You notice I used the word disruption before. Classic startup. Industry old as the hills. How long have people been travelling for and booking hotel rooms for? The disruption was the technology made it available, it's more jargon, to disintermediate, to get rid of some of the steps and parties in that transaction chain. And all of a sudden, people were buying his inventory that he'd been selling for a while as an inbound tourism operator, been selling it to foreign travel agents, was now selling it direct on a website. And that company grew massively over a period of 5 years and was exited in 2004. A bit of a long story there, but it's important to understand the nature of startup. It doesn't mean a starting business. It means a business, and in our case, we don't tend to focus on businesses doing something totally new. That usually means technology risk. We focus on businesses that are in large, deep industry sectors where we can really understand the sector and the business dynamics and what's going on and who's taking what cuts and commissions and what the user experience is of that service. We knew what it was like booking a hotel room. We went to the travel agent and he said, I'll get back to you in 24 or 48 hours after I set my fax or telex as to whether they can confirm the rate and availability. We knew that experience and we knew the improvement that we were bringing. And being a startup in the technical sense, being disruptive, meant that the public in droves moved from the travel agent model. Put your hand up if you normally book your hotel rooms online. Put your hands up if you do. Okay, it's 100% normally book online now. Now that took 20 years and something like 45–50% of all hotel room bookings are now happening direct online. 20 years and the shift is only halfway through. So we're talking deep industries, long-term trends, well-known dynamics, established markets. You add in disruption, and that's where the super profits come. You say, how can one find businesses that will grow at 25% compound and 50% compound? Well, the answer is you can't if you're competing on a level playing field. You can if the business is disruptive, because the old players are using a horse and buggy and you're using a steam car or a petrol car. Away you go. You win for that reason. Okay, that slide number one, just a little bit of anecdotal background because it's fundamental. It just shows in the public market sphere how that's played out. Back in 2001, there was one tech-type company in the top 5 by listed value in the world. Today, 5 out of 5, you know the names, Amazon, Alphabet, Microsoft. I'm not even sure if that's up to date. I don't know if they've skipped the Chinese or not, the Tencent and the Alibabas, etc. So that's just validation of what is already historical fact about the nature of the change over over a 15-year period sort of thing and ongoing. This next slide is in the same vein. Again, it's from listed markets because you don't have data on private companies to the same extent. One of the world's largest and best known VC funds out of the States, Bessemer Partners, many years ago started publishing what they call the Cloud Index, which is an index of companies that provide software as a service in the cloud, listed companies from the US. And you'll see there the divergence, that cloud index compared to the NASDAQ or the Standard & Poor's or the Dow Jones, since August 13 to August 18, it outperformed by 3 or 4 times any of the main indices. So another thing I want to point out is none of this stuff is, with that length of time behind us, none of this stuff is fad. One of the tricks as a VC when you're seeing deals is to pick between what's a fad and what's a long-term trend. We only invest in long-term trends. So we didn't invest in Pokemon. We didn't invest in Bitcoin. Something like how you book an airline ticket or how you book a hotel room or how you order your coffee, you can predict trends there. You can see what's going to happen with considerable clarity. Okay, that's the macro landscape. Software is eating the world. The Australian landscape, what's happening from a financial point of view, I used to be a partner at Deloitte, left there in about 2009 or 10. So I've been watching this space intensively since then. And what's happened is two trends that are shown on the slide we're looking at now. One is, since 2005 to 2015, the cost of starting a business from the viewpoint of tech infrastructure, so having a website, having your source code, your programs, your ability to pay online, all that stuff that you need, let me call it your store, your whole store infrastructure, digital infrastructure, the cost of setting that up has gone down between 2005 and 2015 100-fold. Now that might sound like hyperbole, but let me tell you, in 2005, you had to spend tens of thousands to build the ability to take a credit card payment online. Code was clunky, you couldn't get it off the shelf, there were no cloud computing services available, you had to buy all the computers yourself. So not only has the cost of computers plummeted, the efficiency of writing software has massively increased, and today you can buy most of the stuff you need to set up your business plug and play at nominal cost, software as a service. So you don't build your own banking connections, you don't build your own CR, customer relationship management stuff. It's all plug and play. And that's critical, because what that means is the cost of starting up a business has fallen 100-fold. Correspondingly, there's been a rapid increase in the number of in the use of technology in general, but in startups that are spotting new uses for the technology, because as it falls in cost, it becomes cost effective to apply it in more and more situations. Everyone sees the stuff on TV about solar panels, how the cost of solar has come down, making it more viable. But that's a broad-based proposition about tech becoming cheaper and therefore more viable to start more and more types of disruption, become cost-effective. The other side of the slide we're looking at shows the money that's gone into VC funds in Australia. You'll see there's been a huge ramp up 2014 through 17. Number of things going on there. The government finally got onto it. We've got to keep up with the rest of the world. The future is not about coal mines. The future is about artificial intelligence and self-driving cars and those sort of things. So the government jumped on board. We've got tax concessions and other incentives, and our Australian startups now have got the Australian government has set up offices in 4 of our major trading partners where an Australian startup can pre-arrange to go over to Singapore or London or Tel Aviv and get free office space and introductions. It's a part of DFAT type arrangements. So the whole ecosystem has changed and the money is pouring in. What's useful about seeing the two graphs on the one page is that both sides of the market have grown massively. So I don't think we're in bubble territory. That's happened back in 2000, where the market got way ahead of itself in terms of where technology was up to.
Hey Les, just look back on that slide if possible. So with the advent of a lot more funds and players coming in, what should we look out for there? Because, you know, sometimes where historically we've been hurt is where there's been a flood of money, flood of new players. So maybe talk to that.
Yeah, well, to quote Shakespeare, a fool and his money are soon parted. We're seeing huge deal flow. Most of it's rubbish. We're seeing huge deal flow. And we play, you'll see in a later slide, in a very early sort of first, if you want to call it an institutional A-round space. You've got a bunch of individuals, high wealth officers piling in, taking individual punts, a little bit like investing in the stock market where you don't know what you're doing and you pick a few names, your mate told you in the pub, or I've heard of BHP and you put a few bob on it. And by and large, I think people do their dough if they go in without experience and background. The other thing we're seeing is, you see a huge spike in FY17, 1.3 billion coming in. We're now seeing institutional money coming in. So an increasing number of super funds are saying it's got to be in our portfolio. We can't miss out on this. So institutional money is piling in. A lot of the big corporates are piling in. Westpac, NAB, Telstra. There's probably a dozen of them now have their own VC funds and incubators. So it's not, when we talk about VC, it's not you've got to go down into more detail. There's a lot of big money coming in. There are a lot of funds that are big by dollar value. Square Peg, Airtree, those sort of people are raising funds now, $100 to $300 million. Totally new in Australia. Used to have it in PE, the old Champ Ventures. Now we're seeing it in VC. The other thing that's happening is there are a lot of people that were investment bankers and partners in legal and accounting firms and consulting firms. It's a fashion. They're starting their own VC funds. I worry about some of those because those people have got great skills in looking after large clients, but I don't know what they do when they sit across the table from two founders who say, look, we started 9 months ago, we now have 4 staff, roll up your sleeves and help us. I don't know if the people who've only ever worked in the city, on the BHP account, are well suited to helping them succeed. So that's another concern I have, and indeed there's been a few articles in the startup press recently talking about that. Okay, let me roll forward because otherwise we're going to run out of time. Following that theme about where we sit in the ecosystem, for those on the phone, we're up to a slide now that shows, where EVP fits. You've got a whole bunch of funds that invest, at a very early stage, pre-revenue, R&D, please fund the development of this business model or the build of my website and technology. And then you've got ones that invest in the later stage where their minimum check might be 5 million, and or they're taking bigger, longer-term risk on technology. Some of the small ones that you may have heard of, things like Sydney Angels, Tankstream Ventures. You've got all these little startup incubators and so forth. And at the top end, you've got names you'll know, Airtree and One Ventures and Reinventure and so on. We fit in the middle. We won't invest in an idea or a product or a technology. We invest in a business, i.e. you must have some trading income, you must have enough track record for us to be able to sniff it, touch it and form a view about the viability of the business and its ability to disrupt and grow. And really, we have a very good relationship. The question about the weight of money coming in, we've got a great relationship with the bigger boys. If you're running a $200 million fund, you can't take $500,000 and $1 million bets. Portfolio's too big. Either that or they're blind punts. Too much manpower needed to get into them in detail. So a number of those, especially Airtree, tend to send us the ones they say, look, this looks interesting, too early for us, too small a check size, want to have a look. And then we've actually had Airtree and Bailador get involved with 2 that we were in that have matured, now need a bigger check size, and we help them with introductions. So we see those big funds as our insurance against the next downturn. We're talking a lot of people, the financial planners, those that I've been talking to, the investment houses are all nervous about the next 12 to 24 months, but we're underwritten. Those big funds have got hundreds of millions committed, so it was 1.7 billion committed in financial 17. They're going to have to call that money and invest that money. They're not going to be investing in the sort of mushrooms growing at the bottom of the rainforest. They need businesses of a certain size. Those businesses come from people at our size. So that's our recession underwrite. What do we do specifically? We're looking for software in particular that disrupts the traditional industry. Working with the right people is critical. At the end of the day, if it's the best business model in the world, if the founders aren't competent and honest, it ain't going to go anywhere. You're going to do your dough. We'll only invest where we've got enough track record. And that might be very early. It might be 6 or 12 months trading. But we've got enough track record that we can see who they're selling to, how they're selling, what's the cost of selling. We can make some intelligent predictions and guesses about whether their selling costs are going to go up or down. So is it the founder's personal talent and charisma? Or is it a channel that can be scaled? Those sort of things. Sustainable unit economics, we're big on that. There's a whole separate accounting science for assessing a startup. We're looking for large and well-defined markets. I'll give you a couple of examples later. And we're looking for sustained revenue growth, long-term, so no fads, only trends. The overview of the fund, we're targeting about 25 million. If it goes much north of that, we'll cut it off and not take more because we don't take money we can't invest efficiently. Minimum investment 200,000. We're looking for return over 7 years of about 5 times cash, which is circa 25% IRR for those technically minded. The term is 7 years. The fees are in the information you've got, and our structure, which is the most common form for a VC fund in Australia today. It's a government statutory regime that we comply with, which means that our investors get a 10% tax rebate on funds invested, and the important part is capital gains are completely tax-free. So you don't have to be in a super environment. You can be a top-rate individual or the family trust structure, all gains perfectly and completely tax-free, statutory concession.
Hey, Les, whilst you're on that slide, worthwhile just quickly talking about the cash flows, just to give us sort of a top line cash flow. So typically what will happen with this fund is we'll draw sort of a third over sort of calendar year 18, 19, 20. That's really sort of high level. We'll call the money as we need to buy investment companies, but just to give you a guideline, a third, calendar year 18, 19, 20. So, if you're making a $300,000 investment, we're going to call 100, 100, and 100 in a linear fashion. That's what we'll do. It won't be as linear as that, but and then essentially, depending on how much we're deploying each year, that's what the tax rebate is applicable to. Okay, so we've got to deploy the money, and from a cash flow point of view, first year investee companies, of which we may have 3 or 4 companies in this fund by the end of this year. We already have 2. Looks like we'll have another one coming up, Les. But basically, that may take 3, 4, 5 years before we start to see an exit. So, first year investee companies, it might be year 4 or 5 before you start to see some exits coming through. So it does require patient capital. You are going to get a nice little quasi yield from the government by a tax rebate, but this is patient capital, and the payback is there in the 5x cash.
Is there an option to extend beyond 7 years?
There is. The manager's discretion, we can extend 3 times in 1 year lots, so absolute maximum is 10. Our documentation tries to deal with situations to make sure we can exit in 10. And being realistic and candid, I would be surprised if we could exit everything in 7. Again, these things tend to work on a normal curve, not an all or nothing.
Actually, the Site 90 case study goes to the very heart of that issue, about whether you sell or whether you hold. It's the Atlassian story as to why you stay in something. And Les's investment post-hotel club, Site 90, which is a sort of a derivative of the hotel club experience, which we'll talk to you later. He still holds today. He's the second largest shareholder in that. It's a global leader in what it does. He has elected to stay in it. You can talk to why, perhaps that's a good way of explaining as to why we might hold a company for longer than the 7 years.
Okay, well, let me...
My question was, so Is your aspiration to identify, say, 5 to 7 companies every 12 months, or what sort of?
Yeah, look, if the fund is, it's called circa 25 million, I'd expect to have about 10 or 12 companies that we invest in.
Right, so about 2 million each.
About 2 million each, yeah. So, and the typical profile is the mandate allows us to go from $500,000 to a maximum of 5 million per company. In fund number 1, we've got the investments we've done range from 700,000 up to 5 million. I doubt we would ever put 5 million in straight first off. Usually we want to start with $500,000 to 2.5 million, depends on the maturity of the company and the deal. Yeah. And then we'll double down, usually 12 or 24 months later, when they need their next raise, and we don't really know what's going on. And you often get good buying then because you're an insider, you've got the insider knowledge, and you say to the founders, guys, now you need your next 3 or 4 million. We can either do it fast, in-house, no risk, no DD, or you can, if you think you can get a high valuation, you can go to market, take the risk, spend the time, take the eye off the business, and we get good buying that way. They'll ask me, just give me a little bit of a hint there to segue into some of the personal history. SiteMind, I think this is not from our portfolio, this is my oldest investment, goes back to about 2007. Mike Rogers, the founder there, a mutual friend introduced me to them because of the press and reputation coming off the exit of Hotel Club 3 years earlier. Got a friend that knew about it, was mutual friends with these 2 guys that founded SiteMind. When I met them, they were 2 guys with an idea, and talk about a near brush with misfortune. They first came to see me. I was a partner at Deloitte at the time, and they said, we want you to raise money for this great idea we've got, and it was a PowerPoint, and put it up on the whiteboard. And I said to them, look, a good idea is worth what you paid for it. I'm not putting that to my clients. Go away. Come back when you've got 5 clients, handful of clients. It was just my good luck. They wanted the money. They wanted to leave their day jobs. They were both from an IT background. And where they got the idea from was that one of them had invested in a backpacker hostel up in Queensland somewhere and saw how hard it was to get bookings. You wanted to get bookings from different channels. By channels, I mean bookings.com, Agoda, hotels.com, Expedia, etc., Webjet. You wanted to get bookings from all over the place, and he saw it was impossible to manage because those places will not give you bookings unless you give them stock on consignment. You block a room out as booked in your hotel management system and you give it to them. So your hotel management system says it's been sold, and then you get busy, I've got no inventory left, let me go back to bookings.com and I can take it back. And it works if you're dealing with bookings.com, but not if you want to deal with 3 or 10 or 15. And this is where we get into disruption and the power of the technology. So I had this idea, what if instead of giving out 5 rooms to each of 10 channels distributors, and I'm out of inventory, and instead of taking them back every day and every night, because you think about it, at a hotel, it's one piece of inventory, 1 room is 365 nights, instead of trying to manage that with 10 different distributors, what if there was one control panel where I could think warehousing logistics, so I could put my stuff into a central warehouse and it distribute it to all 10. That's what SiteMinder does. It does that digitally. So it connects to all those big booking websites, connects to the hotel's inventory management system. It's just a switch box, just a link, distributes inventory. Anyway, it was my good fortune. There were 2 mics that started. They came back 8 or 9 months later and said, Les, we built it in the garage at night. We're up and running. Revenues are now $500 a month or $600 a month. And I looked at it, and again, because I understood the industry from having worked with Leon and Hotel Club, I said, okay, let's talk Turkey. I ended up as their first investor, and the rest is history. That we did 3 or 4 internal rounds, what do we call it, angel money to scale it. Then it got beyond our capacity. My colleague Howard Liebman, who I'm partnered with on this VC fund, this is going back many years ago, I introduced them to him, and they got him to help with their first VC fundraising. We weren't in that game yet. And they raised money from Bailador, which is it's actually a listed VC fund, very unusual in Australia. And I'm still on the board of that company with Bailador. And then the next round after Bailador got the scale where we went to the US VC funds, and we raised from a fund called TCV, which is one of those American behemoths. One of our problems, I don't think I'm breaching any confidences here, when we went there was that we were looking to raise circa 15 or 20 mil, and their minimum check size was US 30. So US is a different planet. We managed to handle that situation by having a mixture of investment in the company and sell down of shares. And Dale's point, if you look at that, that's already doing circa 11 years. I'm still in there, still on the board, still trying to help them add value. But if you look at the graph, the business just keeps growing. We're sort of circa 630 staff, 5 offices around the world, and it's just not the right time to sell now. That's the granddaddy in the portfolio.
So ordinarily, there will be companies will be out of in 3 or 4 years, but there may be a company that makes absolute sense to stay in, to create the value for the investors, and you really are relying on the portfolio team to make those discretionary calls, whether buy or sell. But typically, with a 5x target, we're expecting you to get your cash back, probably from a couple of exits, maybe year 4 or 5, and then we're playing with the balance of the portfolio thereafter.
That's right.
Les, with some of the larger companies that you invest in, do you look for broad representation? How does that work?
In terms of what we do, again, the difference between us and most managers, I actually circulated to a few people last Thursday or Friday, again, an article from this. The whole thing is, the whole startup VC thing is just grown like a nuclear mushroom cloud in the last decade, from starting from almost nowhere. It's got its own literature and research and metrics. I circulated an article that talked about the fact that everyone's commenting on how much money there is. How many lead investors are there? So a lead investor, the Lemmings game, we all sit around the room, everyone's waiting for somebody to invest and we'll follow. So the lead investor is the one that makes the judgment call, puts their name on it, negotiates the terms usually, and the others follow.
Set the valuation too at the time.
So they set the valuation, yeah, critical. They're usually the largest check. They set the valuation and the terms, do the negotiation. Everyone just follows along and tries to get a bit of a free ride. But the point about this article was, around the world, and I include Australia in this, there are a lot of investors. There are very few lead investors. A lot of Indians, very few chiefs. We are very much a lead investor. So in portfolio 1, which is up the screen there, you've got the company names. You can look at the websites.
That's the direct portfolio.
That's a direct portfolio in fund number 1. And fund number 2 will be very similar. That's why it's relevant. And indeed, it's possible, to the extent that these need follow-ons, fund number 1 is now fully invested. That's part of our potential deal flow. But coming back to it, on those, there are 11 companies we invested in, and we've got board seats in 10 of them. And we're very activists. We don't take a board seat in order to make sure we've got the accounts, and it's not a reporting thing. We take board seats because we actually try to make it happen. So my own background, I was actually chatting with one of your colleagues earlier on. Back in the days when I was a university student, I started my first business selling ladies' wear out at the markets. And you don't get more grassroots and competitive than that. But that's the skill that we bring to it. We're not scientists and tech people. We're business people. So yeah, we're activist lead investors, we're lead investors. Yeah.
Just building on that, it seems to me that the limiting resource in all this is going to be your ability to be an active lead investor. Yeah.
Yep.
Because through board seats. If you put EVP 1 and EVP 2 together, you're going to be active, say, lead investor on at peak time, probably 15 boards. Yeah.
Well, again, there are 5 of us in the team. And the other thing that's a common pattern with VC, it's a model borrowed from the US. Sometimes when you've got specialised industry type scenarios, you sometimes bring in what they call a venture partner, who's not an executive, but somebody with experience from the industry. So SiteMinder, for example, the American fund TCV, they brought in a gentleman who was one of the vice presidents of Expedia, retired, it's not conflicted. And the deal there is, look, we'll let you come in and co-invest with us, putting a few $100,000 of your own money on equal terms. And the trade-off is you take a board seat with us and provide industry expertise, so the load on us is a lot less. We're a team of 5. We typically go, if it's a small company, might be one of us goes to the board meetings. If it's a bigger investment, a more sophisticated company, 2 of us will go. And the answer is, I think the balance of the workload, if it does get too much, at the moment we're quite happy we've got capacity, we'll be looking at bringing some more venture partners. It's a business that has high leverage because as a director, it's an odd thing. The bigger companies, the ones that get really big, actually take the least work. So a lot of this is counterintuitive because you've got a professional CFO, a CEO who's either an employee professional or the founder is now 7, 8, 9 years older than when you first met him and he's learned a few things. And they're properly run. So that might be a board meeting. It might take 1 day a month. The smaller ones, some of them will take sometimes 2 or 3 days a month because you're going in and helping them with different things. But I'm comfortable we've got capacity, and if necessary, we'll employ more capacity. But I'm not foreseeing that in the short term. We'll probably employ another analyst and a sort of office manager type person, but I don't see us employing any more senior people in the context of this fund.
Yeah,
we've got the capacity.
It would be my thesis, if you like, that you can be successful. You've got all your criteria. You're successful in 2 ways. 1, because you pick, but 2, because you can put significant time and energy into being the lead investor.
Yep.
Because when I work with these companies, you can't even get them to produce a P&L sometimes or a balance sheet.
Yeah.
So I just need to satisfy myself that you're absolutely convinced that you're not trying to grow too fast beyond the capability of your senior executives to execute that lead investor role.
Look, what you're saying and thinking is wise. I don't know if you noticed before when we were looking at the slide, one of the slides, it says we're targeting 25, and I said, if we go much beyond that, we'll stop taking the money. Right. And it's for that reason, I said, I think I phrased it because I know the confidence we invest it well, and that relates to what you're talking about. It's not about deal flow, it's about capacity. So you are right, but I wouldn't be looking to raise money that I didn't know we've got the capacity to look after properly. That's why we're not looking for 100 million. We talked to one of the super funds who said, oh, look, yeah, we're really interested, but our minimum check size is 50 mil, shall we talk further? And we sort of thought about and said, look, not our comfort zone in terms of size, and also we're more high wealth individual market than institutional. But yeah, you're quite right. It's a serious issue, and my comment before about a lot of people getting into the game that don't really have the skills. You're absolutely right.
Yeah, I was just going to validate that point. Part of the due diligence for us was exactly that. We're up to 15 portfolio companies, median sort of investment 2.5 to 3 mil. You're going to cap out at a 40 mil equity type fund. That's manageable. Beyond that, some of the groups that we've seen in the space that have got 200 mil to deploy, they're playing later in the stage. They're a potential investor in one of the follow-on rounds. But for us, with the type of focus in that that sort of early stage venture, I think up to 15 portfolio companies is as much as we wanted to see.
So yeah, my guess is on fund number two will be similar to fund number 1, similar amount of money. So 11 companies in fund 1, 10, 12, that order scale in fund 2, and so across 5 people, I think we can comfortably manage that in terms of the directorship level guidance and.
What about the risk associated with these 5 people? Are you all in it?
Well, 4 of us are executives and we're partners and equity share, profit share, whatever. The 5th of it has got a 5th partner is a chap called Craig Butcher. He's actually from a slightly different background and of great value to us. He was actually Australian, but spent most of his working life in Europe managing a €3 billion PE fund. They came back to Australia 7 or 8 years ago. Has been doing startups since then, but he brings an interesting added perspective. And again, he's incentivised to make it succeed. He participates in the success fee component of it, which is a common model for VC funds. Spends about a day and a half a week in our offices. I think we're a really good team. We really like each other. We work well together. I'm not in the least bit concerned. And B, in the context of any of us, if we did walk away from it, it's all in success fees. We don't make money on the management fee. We'd be walking away from our, the big gold nugget at the end because we're aligned with you. Okay, Dale's added this slide. I'm a little bit shy about this one because this is going further back in time. It's my personal portfolio, which goes back to 2000, well, in case of Hotel Club, is 2000 or 1999. But yeah. And I've had a degree of good fortune, and this is a longer time frame. But again, you can look up any of these companies. Well, Hotel Club has been absorbed into the big Priceline group, so I went to an independent brand. But all the others, you can look at their websites and see what they do and where they're up to. Generally, very good return. On average, it's 14 times capital invested. That's over a lengthy period of time, different investments at different times. Not everyone's a winner. Drive my car, oddly enough, I could spruik it and say it's now a listed company. It's under the ticker CL8. Between us, it's been a lemon, and the real background is the founder turned out to be dishonest and years, and it happens. Not everyone's a winner. Let me roll forward. Okay, this is just our fund number one portfolio. So the previous slide was my personal portfolio, the history, just sort of validating that we've been at it back since 99 or 2000. This is what we've done in fund number one. Again, all those companies, you can look them up. Some of them we've done very recently, Vital and Vendor Panel, both in the last 6 or 8 months that we drew our checks. Very, very happy with the portfolio. And then you've got some parameters there of how much we invest and what percentage we own in each company typically.
Well, do you look for natural synergies within those companies that you invested?
I would love that, and I put a bit of effort into trying to get some of these people together. The truth is, and this is some of the learning that's not textbook but real bitty life, the good founders are so passionate. It's not just about the money. The good ones, they're solving a problem. They're building something. They're building the pyramids, and that's the problem. Even if it would be rational from a higher level to partner with someone that I introduce them to, they're so busy with their own agenda, it's actually quite hard to get them to collaborate unless both sides see an immediate commercial financial advantage. So you're right in theory, harder in practice, but we do look for that, obviously. But you won't find one industry theme there. We're obviously strong in travel. I guess if there's a theme, there's only sort of 2 types of business there. I think 9 out of the 11 I'd characterise as software as a service, and just about all of them are B2B software as a service, and there are strategic reasons about where we're up to in terms of the economy and the stage of development of technology and where the opportunities are as to why we think B2B SaaS is for now and the next few years. No one's crystal ball goes beyond a few years. The place to be, and then there's a couple of B2C marketplaces there as well, which still have some life in them, although that model is getting more and more crowded.
And you're learning out of that exercise is B2B SaaS is where you want to play in Fund 2 because the B2C building a brand in consumer land is hard work.
Yeah, and one of the reasons, okay, just zooming out, back from when I was a partner at Deloitte and Hords before that, we had lots of clients start restaurants. People were motor dealers and importers, and why they start restaurants? Because everyone goes to restaurants, they think they know how to do it. And from the front of shop side of it, there's waitresses, there's plates, you think you know what you're doing. It's the same with as I said, we're about business. Forget the tech, but it's the same with what the tech empowers. It empowers you to sell on the web. So everyone thinks they can start a marketplace because they're bought in a marketplace. And most of our clients lost their money in restaurants. And it's going to be the same, I think, now with the marketplaces. Unless there's a really strong angle, you're not going to make it because it appears so simple and self-evident, but almost any B2C market you pick, there's half a dozen people piled into it already. Okay, that was our fund number one, again, more detail on the portfolio. Our average holding period, so fund number one was 2 years old last month, so it's a very new fund still from that point of view. But our average growth of revenue in the companies over that period is 155.9%. And that's, again, that thesis of we're looking for disruptive businesses, hyper rapid growth in that early stage off a small base. What's our investment process? Very high level. For fund number one, these are actual stats. We got circa 2,200 inbound pitches. A lot of them are rubbish you can discard in 5 minutes. We actually looked in a little bit more detail at 800 companies. We met with 300. 24 went to our investment committee, and once you're at that level, you've had 2, 3, 4 meetings with them. You've done some DD, and then we actually invested in 11. So out of 2,200, 11 invested. The sort of DD we do, typically, it depends on the company and the circumstances, but typically we try to check out the founders and their background. Obviously, the data they're giving us is accurate. Sometimes we'll go to the level of ask them for their access to their Xero account. God help you if you doubt that the people are honest. If you're at that level, you shouldn't be dealing with them. But often people don't understand their own data. And with our experience, sometimes you say to people, hang on, if you're doing this or that a bit different, it'll go much faster or better. Or if you look at it this way or that way, you add value. But we get the DD of looking at their numbers, talking to some of their customers where we can, it's appropriate, using the product, having third parties or people we know that may have industry expertise where that's relevant, try it out. So we get pretty deep into it before spending our clients' money, and our own money, I should add. So what do we look for? The right founders. Wrong people, doesn't matter. You'll do your dough if everything else is right. Wrong people. Right business model, talked about that. Timing's important. I got my lucky break, hotel room bookings online. We've seen several of those come in the last 12 months. Wouldn't touch them with a barge pole, not unless there's some very specialist niche. Because a general hotel booking room online would be crazy to invest in it now and try to compete with bookings.com. So timing is important. You want to be, not the bleeding edge, but the cutting edge, that old saying. And that's very true with tech. I won't go to the alphabet soup, there's a whole bunch of key performance indicators that you measure with a startup: customer acquisition cost, customer lifetime value, payback period, the contribution margin that you get per sale. If you don't know this alphabet soup, you should learn it.
Just in the interest of time, maybe we go to some of the current portfolio.
So I've mentioned SiteMinder already and what it does, and to be honest, I'm at the stage on that one where I would be happy to see us look towards an exit in the next 12 months. Our big USVC fund is saying, no. The rate of growth we've still got, we want to sit. It's been not publication, but that's, I've talked about that one. The Resdi is an interesting one as well. That's one that I invested in originally, and some of you may wince at the potential conflicts here, but declare, disclose, try to deal with it properly. A lot of my personal background, and now the background of fund number one, and Howard's personal background, are all your background, your reputation, your contacts, and in my case, some of the companies I've invested in, that's all fuel, momentum coming into the fund too. And Resdi illustrates that. I took a personal position in Resdi back in 2011, long before we thought we were going to go into funds management. It was just me. This chap, Simon Lenoir, he's actually a French chap, IT, must have had his midlife crisis very young, in his middle, late 20s. He went backpacking the world. He's a diving instructor, ended up running a dive shop in Bali. I can't remember if it was Bali or Thailand. For 6 months, he settled down there and was running a dive shop. They wanted someone who spoke English and French because that was their customer base. So the Westerners in those third world countries for diving. And he had a hell of a time. All his users were from overseas. And how do you handle bookings? You've got boats, and you've got dive masters, and you've got diving rental gear. How do you manage all that if you're trying to deal with it by people walking off the street? Imagine this dusty road somewhere on a beach somewhere in Bali. So he came up with this idea that it should be booked using software. Same way as hotel rooms are booked. Let me book. And he said, okay, what if I could set up a system? Think of it as a big Excel spreadsheet, and then it gets fancier from there. I say I've got these 3 boats, and I've got these types of dives, and I schedule the boats for the year. So boat number 1 will do the morning dive from 9 till 11, and we'll go to this reef on Monday and that reef on Tuesday, and whatever it is. You could quickly schedule all that up for a year. That's your inventory. And then if you could make that inventory bookable online, the way you do a hotel room, book and pay online, keep the customer records. Oh, I'd like to add an underwater camera to that. Adds the bill up, bills you, handles the payment. He came up with this idea. So Resdi, I think it stands for reservation ready, if you think in French. I'm not sure. I met Simon and his co-founder, again, just 2 guys at that stage, no staff, both ex-software backgrounds. And they pitched a thing called Sydney Angels, we've got one in Melbourne, which is a sort of seed stage, very early stage. They were up and running. Again, they had, I don't know, a few $100s a month of revenue. And again, because of my background and some of my connections in hotel and tourism and so forth, I got it. Now, the Sydney Angels process is interesting. Once every 2 months, they have what they call a deal screening meeting, where 6 businesses pitch and get feedback and mentoring, and the inner group that goes to those sessions likes best. The committee chooses the 3 best, then go on to a full members meeting in the alternate 2 months. Now, Simon didn't even make the cut. I think he ran sort of last 6 out of 6 at that deal screening meeting, didn't make the cut to go to a full meeting. I took him aside, had a chat to him, and the rest is history. And back in 2015, our first fund invested some money in that business. Obviously didn't vote and didn't take a view on that. And then 2017, we doubled down. So that's actually our biggest investment in Fund 1. Again, very similar to SiteMinder in that it's in a business that's, well, until 2 years ago it was Australian only and a head office here. We've got 2 little offices in the States now, so about 14 people in the States and about 30 people in Australia, 35 maybe now. Still on the board, still very, very active. Customers all around the world. So tour and activity providers. Think bridge climb is a customer. Think walking tours. Think whale watching boats is a big category for us. So all sorts of tours and activities. And to show the business horses, it's not about technology. We all know you can take a booking online. We all know you can put a diary online and process a payment. The pitch from Simon that sold me is when he pitched, he got up and said, look, you know, when we travel, and you're talking about leisure travel, when we travel, the first thing you do is you want to book a flight, you do that online, book and pay. Next thing you want to do is you've got to stay somewhere. You're not travelling for the sake of being on the plane. It's a means to an end. Next thing you do is book a hotel room, book and pay online. But you're not travelling in order to sleep in a hotel bed. You're travelling to do something. When you try to find stuff online to do and book and pay, it's all over the shop. Now, I totally got it because I saw the development in the hotel industry of the business networks and those today familiar big websites that aggregate all that hotel inventory from around the world and make the process slick. That's yet to develop in tours and activities. So this business does exactly what SiteMinder does. It provides the operator with the software to run his business, to take the bookings. I've got a whale watching boat, how many seats, what's the cost, upload the pretty pictures. It does all that and then allows you to distribute digitally through third parties. I know we're running out of time. I'll mention 2 more companies quickly. These are companies which Fund 2, which is the one that we're currently raising for, has already invested in. Fusion Sport is fascinating. I'm sure we've all read about data about our health going up in the cloud. Fusion Sports is a niche play on that. It collects data from about 60 different devices that measure biometric data, so everything from diet to pulse to acceleration rate, and it targets the elite professional athlete. So the clients are things like the top NBA teams, the US and Chinese Olympic committees are customers. So don't think Fitbit, if you like, it's like your pot in your kitchen. This is the heavy duty industrial for professional organisations. We're massively optimistic about that business. Very happy with that one in our portfolio.
Just make a comment. You would have heard about Leon Kamenev, who was behind Hotel Club, who came from the online travel industry. You would have heard about Simon Lenoir, the dive operator of Thailand, who set up the tour experiences. Marcus Deutsch here was the head of conditioning for the All Blacks rugby team in New Zealand. An insider, sector specialist within his industry, developed a program solution to a problem about how you analyse human performance management, solved the problem, then went out to the industry, talked to the industry about it at different conferences, has now become the global leader in athlete management. The US Defence Force has now done a contract. So the opportunities of this business are through the roof as that arms race that we all see in professional sport, whether it be Olympic committees. Every AFL club uses this system, every NRL club, the NFL clubs. You have a look at the who's who of the client list, it's out of the world. So really, if you get your head around what's happening in this business, which is part of Fund 2, it's absolutely an insider who saw a gap, provided the solution, and then has taken that to the market. Never had business development team, and yet has become almost industry leader. Now the resources are going into building out the business development part of that business. So no technology risk, just about a business development exercise.
Yeah. And that's an interesting theme in terms of learnings, prejudices, preferences, and none of these are rules. But I tend to see the world in terms of 3 types of founders. You get money people, people from a consulting, financial advisory, investment banking background. They do a startup because they want to make money, generally. Not my favourites. Then you pick from a tech background. Oh, geez, I worked for a startup and the owners got rich. I actually did all the work because I wrote the code. So now I'm going to find some code to write because I think I can get rich. I maybe like them sometimes better than the money people, but not my favourite. And Dale's point, my favourite are the industry insiders because they're ones that have seen a problem as a user. They know exactly what they need and want and are frustrated they can't get it, and they know that it's not available. Otherwise, they would have bought it from someone else. So they're my favourite because then you get real product knowledge, real industry knowledge, and no one need and no one absence in a relative sense of competition before you start. Because you can employ the tech people and you can employ the CFO. So that's a useful point from Dale there about what we tend to favour, and it's a pattern that many of our founders are industry type people. Not a rule. We don't have prejudices. They're not prejudices, but they're patterns you observe. And I'll just mention one more, which is the other one that's in the fund that we're talking about now. We've made an investment decision on, and I think we're in legals at the moment. I don't know. I think we've just paid or just about to pay the cheque over, $2 million. A company called Pendula. The story with Pendula, and you'll all relate this story as users. And your kids will relate to it more than us. 10 years ago, if you're on the web, that meant that you had email. Probably that was where it stopped. Today, well, I personally have got WhatsApp. I personally use WhatsApp, email, a number of specific apps for communicating with people, SMS, and I'm not much of a power user. So what's happened is the number of communication channels that people use has grown massively and continues to grow as newer and newer fancy apps come up. And that's a problem for business because people have their preferred ways of communicating. Some people will say, I want all my work goes through my email address, my family stuff goes through WhatsApp, my artwork goes through Instagram. My wife's an artist. So they've got their preferred means of communicating, and some might have several preferred means of communicating for different parts of their life. Now, if you're a company trying to interact with your customers or to sell to people, it's a massive advantage if you can communicate with them in the way that they want to be communicated, in the right medium. So what Pendula does, and they're targeting more substantial businesses as clients, what Pendula does says, okay, you've got a CRM and you've got some super fancy version of MailChimp equivalent, but your customers don't all want it by email anymore. They want it through a whole variety of different communication media and apps. Pendula provides a system where you interface that with your CRM. You obviously need to set up the rules for each customer or person that you're targeting as to how they need to be communicated with. But you set it up, and then all your communications, you send them out once, and they go through the preferred channel. So whether someone's going to get it as audio or video or email or in an app, you just send it out once, and it goes the right way to all your customers. And again, for me, that is a self-evident need that's just about unique in the market. There are not a lot of people tackled this problem yet. There's one in America that's similar. And the corporates, we're getting good traction with the corporates. They see real value in it. If it sounds a bit complicated, think of it as simply as this. A company like AGL, what's it worth in dollars? It's not an actual, but it's a type of case they've had. I'm not allowed to disclose a name, but big bill payment thing. If you can communicate to people in the way they like, if that's going to reduce your time in debtors by 5 or 10%, think about the dollar value of that. The monthly bill run or quarterly bill run by an AGL. It's massive. So really keen on that. Look, I might leave it there and open you through any further questions because we've covered a lot of ground. Hope I haven't gone too deep into some of I call them our children. Are there any other questions about what we do, how we do it?
Do you still have access to these slides?
Yes.
Yeah, can you circulate them, please? Yeah.
It's funny, just in the diligence before we end up investing and then taking the opportunity to the market. It's a little quick story. There's another company called Deputy. Deputy looks at a trend in the industry, which is this movement that we've seen to casual and mobile sort of labour market, away from the traditional, having a job, now have a portfolio of jobs. So I tested Fusion Sports with some of the AFL head conditioning people to get their feedback, just to sort of validate what I heard from EVP. And and to a T it was, best in breed. That they were the keynote speaker at the conference. We had all the major players come to Australia for it. So that was okay. On Deputy, I have a sister who's here, has 5 different venues. Silly enough to have 5 venues, restaurants, event centres down at the St Kilda Sea Bars and around Melbourne, out at Essendon Airport. So I sent a text to her and I said, ever heard of Deputy? And she looks after 200 casual staff. Now, think about the headaches you get with 200 casual staff. Someone's had a night out, doesn't roll up, so someone has to come in and backfill. And I got a text back from her, true to label. She said, love it, saved my life, saved my marriage, can I get a discount? so it's sort of, just a validation of the theme about, the sort of businesses that are being invested in where there's been an insider within that industry sector, solve the problem, build a business-to-business solution, take it to the market, and build subscription revenue off the back of it. Can scale it through the cloud, low cost of goods. They're the things that we really liked about it, and that's why we decided to get with EVP and take the opportunity to the market. So appreciate the opportunity. Questions from the floor?
I just had a quick one regarding the companies. How closely are the companies aligned to them? Or do you ever discount companies if they're too close to competing with each other?
Look, we won't invest in companies that compete too directly because I think that would be unethical and create all sorts of problems. So far, we haven't hit that problem, certainly not in any major way.
Is there any sectors you stay away from an ethical base?
Look, we don't have a specific policy, but because we don't, I would be very surprised if we ever invest in anything involved physical manufacturing or distribution, because one of the things about SaaS businesses, and Dale's point about margin, typically the businesses we invest in have got a gross margin, because there's always some implementation and servicing cost even on software, but support this. But typically the gross margin is in the sort of 75 to 90% range. Look, I don't know. I would be surprised if we invested in, I don't know, like a porn site or but I have a policy, but it's just not the sort of thing we come across and not the sort of thing we do. Does that answer it?
Yeah. So can you just remind me what minimum investment is, and if it's sort of 3 years?
It's a $200,000 minimum commitment, and whatever you decide to invest, you should see it as some or all of your allocation to VC, probably spread roughly evenly over 3 years. Now I can't commit to that because it's driven by deal flow, but based on experience of Fund 1 and where we see it, think of the dollar figure as over 3 years. So if you're going to put 600,000 across 2 VC funds over, a VC fund over the next 3 years, you might commit between 200 and 600 to this fund and expect to draw it out over 3 years.
No, I have to do the 75 to enjoy it.
It's a long-term hold.
The kids will love it. It reminds me of that phrase, fly business class with your children.
And is there a broader strategy once you fill this, once you get this fully invested, to just move on to number 3?
Probably, yeah. We're not talking that far ahead. We've got to fill this one and look after our investors and the money in this one, but that is a normal pattern.
Yeah, okay. And how much of the executives of EVP putting directly in to the fund?
As a group, we're putting in about 4.5, and how I got there, I was doing this stuff, as you saw, for many years before. So where this came from, I was doing it myself, and I had friends who wanted to co-invest. I got the same, I said, look, bugger it, let's formalise it and make it a fund, because that gives us some more notoriety and deal flow. But I still see this very much as Les investing, and I'd be surprised if I'm not the biggest investor in the fund. I am at the moment, and probably will be.
Do have one question from online, which is how do you secure a cash exit from an investment?
Okay. First of all, our expectations are made known to everyone at the time we invest. We have written into our paperwork that we've got the right to. We haven't got the right to actually force an exit, because that's not commercially tenable. But we've got the right at least to compel the board to appoint advisors and get advice on valuation and exit. So once you get a bit of momentum going, often it happens. And the ultimate fallback, in a legal sense, is we've got the right to compel the company to work with us in the distribution of shares through pro rata to all our investors, should any of them still be left out at the end of 10 years. Now, that's the legal position, and I won't get look at these realities. It takes, how old is Atlassian? How old is Google and Facebook? It sometimes takes more than 3 or 5 years to be really, really big and valuable. But those answers are probably not the commercial reality. I've invested personally in a couple of offshore VC funds because you get limits of time and expertise. One of those has come to full term, and there the manager said, look, we've got whatever it is, 3 out of 17 left. We can continue to represent you and do what we've been doing for a small fee of X until we sell them. Or you can have your shares in specie, take your pick. And I know I said to them, well, just keep doing it. And I don't know, but I suspect all the investors did the same. That's how it usually works out in practice, in the event you have any left past the end.
Maybe the question was also about the art and science of an exit, as to how you try to...
Yeah, look, timing is damned important. One of the hard things is to balance where you are in the growth of the individual business. So business might be growing really, really well and growing, so it's getting more valuable every year if you look at it on its fundamentals, but you've got to overlay that with market conditions. So, if your flavour of the month, if you're investing, like at the moment, if you put the label, if I had a fish and chip shop and I called it artificial intelligence fish and chips, I could probably sell it at a high valuation. So you've got to judge where you are in the market, because your business could grow 50% in the next 12 months and not be worth as much as it is today. You've got to size both those things up. The two most common exits are obviously either a trade sale or a listing. Most of the stuff we've invested in would tend to be better suited to a trade sale, because then you get strategic value. So a lot of the stuff, especially when it's B2B SaaS, so something like Resi, again, please don't advertise in the newspaper, but at the same time, I don't think there's any harm disclosing it. They've actually had approaches from discussions with both Bookings.com and Viator, which is the world's biggest online. Now, they haven't gone anywhere, partially because we said, we actually named a valuation that was a silly valuation, because if you pay me a silly amount, I'll sell you my house, but otherwise I actually don't want to move. But yeah, because of the nature of the business, you can see the natural industry partners who will generally pay more than a listing because it's strategic value and integration value. I don't know if that answers it, at least partially.
And when you do an exit, can you reinvest any of those funds, or they all get distributed back out to the EVP investors?
No, they get distributed. So obviously we can, if there are any outstanding liabilities, whatever, we can hold funds back, but basically it gets distributed through as the asset sold. Oh, sorry, to be technical, during the investment period, the first couple of years, and it's not, it'll be 1 in 100 chance, but if we bought something and got the mega offer the day after, we could reinvest that money during the investment period, and thereafter, as we exit, it's all got to come out.
Okay. In the interest of time, we'll wind that up, because I know Wes has got another meeting he's got to attend. From a Morrows perspective, we're currently undergoing our own internal due diligence on the fund. At this stage, EVP's got a close date towards the end of November, so that's our time frame. So we'll revert to everyone personally once we've progressed that DD. But yeah, basically we'll be in touch shortly. We just thought this was a great opportunity for you to hear directly from Les whilst he's in town, and get a feel for what Les and the strategy's about, and something that we'll be talking to you further about. So thanks a lot for those that dialed in, and for those people that came in personally, and thanks Les, Dale and Chris for providing the briefing. So we'll